All right, let's talk about something that's running in the background of literally every single business you can think of, from that tiny coffee shop on the corner to the biggest companies in the world. We often think of it as just, boring numbers and spreadsheets, but it's not. It's actually a secret language.
I mean, seriously, think about it for a sec. How does a company really know if it's doing well? Is it just a gut feeling, or the number of people walking in the door? How do they actually measure if they're winning or if there's danger right around the corner?
Well, the answer isn't some crazy complex formula, and it's definitely not magic. It's a language. A whole system designed to tell the financial story of a business with perfect clarity. And today, we're going to learn the basics of how to speak it.
Okay, so let's jump right in and start learning some of the vocabulary. What is this language we call accounting?
Okay, I know, that looks like a textbook definition, right? But stick with me, it's actually way simpler than it sounds. Just think of it as 4 steps. First, you identify that something happened, like you made a sale. Then, you measure it, you put a dollar amount on it. You record it, you write it down. But that last step, communicating, that's the whole ballgame. The entire point is to turn all that business activity into a clear story so people can make smart decisions.
So, who's reading these stories? Well, pretty much everybody. Inside the company, you've got managers who need it for planning and owners who use it to decide what to do next. And on the outside, you've got investors trying to figure out if the company's a good bet. And of course, the government, making sure everyone's paying their fair share of taxes. It's totally universal.
All right, lean in for this next part. Seriously, if you only remember one thing from our chat today, make it this. This is the absolute, fundamental, unbreakable law of accounting. It's the grammar that holds the entire language together.
So, let's meet the 3 main characters in our story. First up, assets. An asset is basically any resource the business controls that's going to help it make money down the road. So let's imagine a little freelance design shop called Pixel Push. That super powerful computer they use for design work, that's an asset. The cash they have in their business bank account, yep, that's an asset too.
Our second character, liabilities. This one's easy. It's just what the business owes to other people. It's someone else's claim on all that stuff on your assets. So, did Pixel Push get a bank loan to buy that fancy computer? You betcha. That loan is a liability.
And finally, we have equity. And this is the good part, right? It's the owner's slice of the pie. After you take all the stuff you control, your assets, and you subtract everything you owe, your liabilities, whatever is left over, that's what truly belongs to the owners.
And this brings us to the golden rule. It's beautiful. Assets will always, and I mean always, equal liabilities plus equity. It's just a perfect balance. Everything a business has is either claimed by outsiders, the liabilities, or claimed by the owners, the equity. That's it. This one little equation is the bedrock for everything else.
Now, one more quick but super important rule of the road. It's called the business entity concept. All it means is that we have to pretend the business is its own person, completely separate from the owner. The money in the owner's personal wallet and the money in Pixel Push's cash register are in 2 totally different universes. You never, ever mix them.
Okay, so we've got the grammar down. Now let's see how we actually use that grammar to build a story. This is what accountants call the accounting cycle, but I like to think of it as the storytelling cycle.
Now, the real deal cycle has a few more steps, but honestly, it all just boils down to these 4 phases. First, something happens. A sale, a purchase, whatever. You write it down in order, kind of like a diary. Then, you sort all those diary entries into different piles. All the cash entries go here, all the sales entries go there. And finally, you use those neat piles to write the official story, the final reports.
And here is where you see the magic in action. Every single transaction keeps that golden rule perfectly balanced. Let's go back to Pixel Push. They buy that $1,000 computer with a loan, while their assets just went up by $1,000, that new computer. But at the same time, their liabilities also went up by $1,000, that new loan from the bank. See? The equation is still in perfect balance. It's so cool.
So after all that work, all the identifying, the recording, the sorting, what's the end product? We get the financial statements. You can think of these as the finished, published chapters of the business's story that everyone gets to read.
Let's start with the question that everybody wants to ask about a business, right? Over the last year, did they actually make a profit? Did they win the game or did they lose?
The income statement answers that exact question. It tells the story of how a company performed over a period of time, like a month or a whole year. And the formula couldn't be simpler. You take all the money you earned, your revenues,
and you subtract everything it cost you to earn it, your expenses. What's left over is your net income. If it's a positive number, hey, you won. If it's negative, well, you spent more than you made.
But that's looking backwards, right? That's the story of the past year. What if we want to know how the company is doing right this second? A snapshot of its financial health today.
For that, you look at the balance sheet. And this right here is the big aha moment where it all clicks together. The balance sheet is simply a detailed picture of our golden rule. It lists out all the company's assets, all its liabilities, and its equity on one specific day. It's a snapshot, a financial photo at a single point in time.
Of course, none of this works if people are just making things up, right? So these stories have to be truthful. Accounting has two main principles for this. First, the info has to be relevant, meaning it's actually helpful for making a decision. And second, it needs faithful representation, which is a fancy way of saying the story is complete, neutral, and as accurate as possible.
So why are we going through all this? Why learn this language of balancing equations and preparing reports? Well, it really all comes down to one simple but really powerful idea.
Hey, remember that big formal definition from the very beginning? The most important part was right at the end, to permit informed judgments and decisions. That's the whole point. It's not about math for the sake of math. It's about giving people clarity so they can take action.
And that's really why this should matter to you. Understanding this language of business is empowering. It gives you an edge, whether you're an investor trying to find the next big thing, an entrepreneur trying to build something great, or hey, even an employee who just wants to understand the health of the company you work for.
So there you have it. We've learned the basic grammar. Assets equal liabilities plus equity. We've seen how that grammar gets used to write these really important stories, like the income statement and the balance sheet. So the only question left is, now that you know the grammar of business, what stories will you choose to read?